So we are covering the topic income from house property. Now, if you have a house property normally, and if you have earning something out of it, for example, if you have given the house on rent to someone, okay, so you're making an earning out of it. So that rent which you're earning will normally be taxable under the income from house property, whether it is a commercial property, whether it's a residential property, doesn't matter. So all income which you earn for letting out a house or a commercial property are taxable under this head. Okay, just read this. Dia, are you there? So we have Kajal, Pratishtha, Manu, can you read this?
Yes, sir. Chargeability section 22. The process of computation of income under the head income from house property starts with the determination of an annual value of the property. The concept of annual value and the method of determination is laid down in section 23. The annual value of any property comprising of buildings or lands appurtenant
Yeah,
thereto
lands appertinent to.
appurtenant to of which the assessee is the owner is chargeable to tax under the head income from house property.
So basically, I told you that the income from house property, the rent which you are going to earn from a house property, whether it is a house property or a land which is part of that house property or a building, so all that will be taxed under the head under income from house property, and it's a section 62 which is called the chargeable section. Okay.
Exceptions. Annual value of the following properties are chargeable under the head profits and gains of business or profession. Portions of property occupied by the assessee for the purpose of any business or profession carried on by him. Properties of any assessee engaged in the business of letting out of properties.
So, normally, if you are making any earning out of the house property, whether it's a commercial or a residential, it will be taxed under the head income from house property. But there are some exceptions. That means any income which you earn from a house property, which is used for your business purposes, okay, or if it is you're in a business of letting out the house properties, that is your business, then it will be income under the head profit and gains of business. So if you are actually into a business of letting out the properties in on hire, so if you earn something out of that, so that's your business, so it will be chargeable under the head profits and gains of business and not under the house property. Okay.
Conditions for chargeability. Property should consist of any building or land appurtenant to buildings include not only residential buildings but also factory buildings, offices, shops, godowns, and other commercial premises. Land appurtenant means land connected with the building like garden, garage, etc.
So basically, first of all, it is all the buildings, whether the building is, used for residential purposes or for factory building or for office, for shops, godowns, and other commercial property. And if you're owning those properties and you're giving it on rent to someone, then, it will be charged under the head income from house property. For example, I have a commercial property in a mall, which I have given it to Pizza Hut. So I'm making an earning out of it. So that is coming under income from house property. It's not the residential house. Okay. So it can be anything. It can be a factory building, it can be an office, it can be a shop or a godown or a commercial premises. If you give it on rent and make an earning out of it, then the income which you derive is actually taxable under the head income from house property. And even the land which can be connected along with the building, like garden, garage, and if you're earning an income out of that, property, so that will also be under the head income from house property. Yeah.
Uh, Conditions for chargeability. It may be noted that income from letting out of vacant land is, however, taxable under the head income from other sources or profits and gains from businesses or profession, as the case may be.
Now, it is only a building or a land appurtenant to. But if it is just a vacant land, if you're, letting out and earning something, it will be, income from business and profit and gains from business, or It can be, income from other sources. It all depends. If it is your business basically, and if the vacant land is part of your business, then it will be chargeable under the head income from business. If you're not doing any business, then if you have a vacant land and making earning out of it, it will go under the head income from other sources. Okay.
Assessee must be the owner of the property. Owner is the person who is entitled to receive income from the property in his own right. The requirement of registration of the sale deed is not warranted. Ownership includes both freehold and leasehold rights. Ownership includes deemed ownership.
So basically, yeah. So you have to be owner of the property. Okay. Then only that income which you're drawing will be taxable under the head income from house property. Okay. The requirement of registration is not mandatory. Even if the house is not registered in your name, it doesn't matter. But if you are making an earning out of that, it will be chargeable under the head income from house property. Ownership includes both freehold and leasehold rights. So you may be having a freehold land or a leasehold land, and if you are earning out of money out of those lands, now normally leasehold lands would be owned by authorities like DDA or I mean Ghaziabad Development Authority or Delhi Development Authority, and they give on lease those property to the people. So that's called leasehold. So where the it can be either a leasehold or it can be a freehold. Okay. So if you're earning out of it, so then you will be have to pay income from. Ownership includes deemed ownership also. So we'll understand what is deemed ownership. Okay, later on. Fine. So this is okay. Fine. Can you read?
Assessee must be the owner of the property. The person who owns the building need not also be the owner of the land upon which it stands. The assessee must be the owner of the house property during the previous year. It is not material whether he is the owner in the assessment year.
So the two things here that you may be owner of the building, but not the owner of the land, because the land is leasehold land. It belongs to a government body or anyone, and it has been leased to you. Say for example, 50 years or 99 years, and you have made a building on it. So you are the owner of the building. So you will be taxed under the head income from house property. So it doesn't mean that you're the even if you're not the owner of the building, the land, it doesn't make any difference. But if you're owner of the building, as it happens in case of leasehold lands, you are not always the owner of the building and not the owner of the land. So the assessee must be the owner of the house during the previous year. So if you have sold it in the assessment year, but if you are owner in the previous year, you have to pay tax, okay, in the assessment year. So you may not be the owner in the assessment year. It doesn't make any difference. Is that clear?
Yes, sir.
Okay. Use of property.
The property may be used for any purpose, but it should not be used by the owner for the purpose of any business or profession carried on by him, the profit of which is chargeable to tax. The income earned by an assessee engaged in the business of letting out of properties on rent would be taxable as business income.
So all the income which is, the property is used for business purposes, that means the income which you derive from that property will be taxed under the head business income. Okay. So even if you're doing a business of letting out properties, then, it will not be chargeable under the head income from house property. It will be chargeable under the head income from business. Okay. Now, I'm just skipping that. Okay. Uh, Income from house property. Yeah. Read this.
In case of a resident in India, resident and ordinarily resident in case of individuals and HUF, income from house property situated outside India is taxable whether such income is brought into India or not. In case of a non-resident or resident but not ordinarily resident in India, income from a property situated outside India is taxable only if it is received in India.
Now, if you are a resident and you have a property abroad, and if you're getting a rent on that, then you have to pay the tax in India, and that property will be taxable under the head income from house property. But if you are a non-resident or a resident but not ordinary resident, and if you are having an income from property outside India, that will not be taxable in India unless the property the income is received in India. Okay. Suppose if you are a foreigner or if you are Indian and you are a non-resident and you're living in India for some time and you're receiving some money in India from a property outside, so in that case you will be taxable in India. But if the money is received outside India and you're a non-resident, then that is not taxable in India, which we have covered, in our earlier classes. So this is very important. Okay. So determination of annual value. So what we have to do is, first we have to determine the annual value of the property. Okay, determination of gross annual value. Then you have to pay some, if you pay some taxes, like, every person who owns a house or a property, he has to pay a property tax or a municipal tax. Okay, so you minus that and rest of it will become taxable. For example, suppose you're earning a rent of 1,20,000 rupees per annum. Suppose you're earning 10,000 rupees rent. Okay, so that will make a rent of 1,20,000. So if you're paying 2,000 rupees as property tax or a municipal tax, so the net value will be 1,18,000. So you have to pay tax on the net annual value and not on 1,20,000. So you will be given a deduction for the taxes which you are paying, which are called property tax or municipal tax. Okay. Now there can be various cases. Okay. Where now determination of annual value under different circumstances. Now, first can be where the property is let out throughout the previous year. Okay. Or it can be a case where the property is self-occupied or it is not occupied at all. So you have a property, but you haven't received any rent because you are staying in that property, or it's lying locked and you are not given it on rent. So there can be a case for that. So where a house property is let out for a part of the year and self-occupied for a part of a year. That means you have given it a rent for only 3 months and 9 months have been, self-occupied, 3 months is let out. So you may have a case like that. Or where the let out property is vacant for part of the year. That means you just gave it on a rent, you are looking for a tenant, and for 8 months you got the rent. For in the first 4 months it was vacant. That means you're not earning any rent. So there can be any kind of a combination that you're earning a rent or you're not earning a rent, or it's vacant or it is self-occupied. So first, where the property is let out throughout the previous year. So we'll do one case like that. Okay. Read this.
Where the property is let out for the whole year, then the GAV would be the higher of expected rent and.
Okay. Now, what is GAV? GAV is basically the gross annual value. Okay. Before reducing the municipal taxes. That means the total rent which you are receiving. For example, like in this case, you are receiving 10,000 rupees rent. So normally, the gross annual value will be 1,20,000, but not always. So where the law says it is like this. Where the property is let out for the whole of the year, then the gross annual value would be higher of expected rent and actual rent received or receivable during the year. Okay. So you have to see what is the expected rent and how much you're getting. Now, suppose you have a property. The expected rent is about, say, 50,000 rupees per month. Okay. But actually you're receiving only 30,000 rupees rent. Okay, because you have entered into an agreement with the tenant that he is going to pay you some money in cash and some money by check. And you are only declaring that you are getting a rent of 30,000 rupees. So you are able to avoid tax, okay, by lowering your actual rent. So in that case, the law says that where the property is let out for the whole year, then the gross annual value would be higher of the expected rent and the actual rent received or receivable during the year. So that the government would get income tax on the basis of expected rent and not on the actual rent. Sometimes the actual rent can be suppressed. Okay. Now, so this is the law. Okay. Is that clear to all of you? Kishore, Kajal, Divya?
Yes.
Okay, so we'll understand a little bit more about it. So, okay, read this. Kishore, can you read?
Determination of gross annual value. The first step for determining the gross annual value is to calculate the sum of which the property might reasonably expected to let from year to year.
So the first thing is, what is the expected rent which you can get? Okay.
For estimation of the same, the higher of the following two is taken to be the expected rent. Municipal valuation, fair rent.
So, there are two values which are available to you. One is the municipal valuation, because you have to pay the property tax on the basis of municipal valuation. Okay. The second is called the fair rent, how much rent you can get from the property. Okay.
But in the case of properties governed by the Rent Control Act, its annual value cannot exceed the standard rent.
So there is something called Rent Control Act in India. Okay. So I have given a link, in this slide at the bottom. So basically, this act was basically to, protect the rights of landlords and the rights of tenants. Okay. So there is something called Rent Control Act, which is there in India. Okay. So I'm not going into that. You can always go through this, link and understand what is that. But so generally the Rent Control Act fixes a standard rent for each area or locality. Okay. So that means you have three numbers: the municipal valuation, what is the fair rent, how much rent you can expect from the property. Third is the standard rent. Okay. So, but in the case of property is governed by the Rent Control Act, the annual rent cannot exceed the standard rent. Let's straight away go to an example here. Okay. Suppose read this.
Jayashree owns 5 houses in India, all of which are let out. Compute the GAV of each house from the information given below. Municipal value,
So let's look at
house
the house number
1.
one. Municipal value is how much? 80,000. What is the fair
Yes,
rent,
sir.
Kishore?
90,000.
So which is more, 90 or 80?
Fair rent, 90.
Fair rent is better, and there is no standard rent. So actual rent is 72,000. Okay. So in this case, we will take the fair rent. Okay. Let's look at it here. Uh, okay. ये क्या था? We look at the fair rent. Yeah. So this is the same. Okay. Suppose the municipal value is 80,000, fair rent is 90,000, higher of one or two, so 90,000. Standard rent is not there. So expected rent lower of 3 and 4, which is 90,000. Actual rent is 70,000. So what will be the GAV? 90,000. Is that clear? Suppose the municipal value is
Yes.
80,000. Then let's look at the first case. Suppose the municipal value is 80,000 and fair rent is 90,000. So we have to take the higher one. Okay. So that means we have to take 90,000 rupees. That is the expected rent which you can get from the house. Now there is no standard rent. Okay. So which means the expected rent will be 90,000. Okay. But you have received 72,000. But you will be paying tax at 90,000 and not at 72,000. Okay. Let's look at the second and ask questions only when you complete all the cases. Suppose the municipal value is 50,000. Fair rent is 60,000. Higher the two, which is the fair rent. Okay. Standard rent is 75,000. So it cannot exceed the standard rent. So that means the expected rent will be 60, but you are receiving 72. So that means you have to pay tax at 72. Okay. Now, house number 3, the municipal value is 65,000, fair rent is 65,000, higher of 1 or 2, 65,000. Standard rent is 58,000, so which is lower, so you have to take 58,000 because the standard rent will, in that case, if it's lower, will prevail. But you're getting 60,000, so that means GAV will be 60,000. Similarly, house number 4, municipal value is 24,000, fair rent is 25,000, so that means higher of the two, 25,000 will become the higher of 1 or 2, which is the fair rent, but no standard rent. That means expected rent will be 25,000, but you're getting 30,000, so that means you will be taxed at 30,000. Now, the fifth one, the municipal value is 80,000, fair rent is 75,000, so that means municipal value will prevail, but standard rent is lower, so that means standard rent will prevail, but you are getting 72,000, so that means you will be taxed at the standard rent. Is that clear? Can you just have a look on that? Just look at the top. Kishore, can you read as per section 23 gross annual value?
As per section 23, gross annual value is the higher of the expected rent and actual rent received. Expected rent is higher of municipal value and fair rent, but restricted to standard rent.
So we have applied this, section and tried to find out what should be the value at which the person has to pay tax. Is that okay?
Yes, sir, but like if a person is not getting that much of amount but still paying rent on a higher
This is
value.
basically, this is, if the person is normally, it will be believed, like in the case of first, he's getting only 72,000, whereas expected rent is 90,000. Okay, so he'll be taxed at 90,000. So income tax authorities will believe that you are suppressing the rent. Okay, fine. Because
Okay.
it is not based on just one, two, or three, or four figures. So they are giving you a lot of, this thing, and then finding out what should be the. So this is basically, so whether you're paying taxes or more or less, it's okay. But this is what the law says. Okay. Anyway, so let's do a question now. Okay, just read this question.
Rajesh, a British national, is a resident and ordinarily resident in India during previous year 23-24. He owns a house in London which he has let out for 10,000 euros per month.
Pound.
Pounds. 10,000 pounds per month. The municipal taxes paid to the Municipal Corporation of London is 8,000 pounds during the previous year 23-24. The value of £1 in Indian rupee to be taken at rupees 95. Compute Rajesh net annual value of the property for the assessment year 24-25.
So it is very simple. So it will be, the gross annual value, which will be 10,000 pound into 12 into 95. So the rent is how much? 10,000 pounds. Okay. 95 rupees is the rate for 12 months. That means his, income will be 1 lakh, 1 crore
1
14 lakhs.
crore.
Okay. So it is coming here. Then municipal taxes is paying 8,000 pound at 95. So it comes to 7 lakh 60,000. So that means this net value will be 1 crore 6 lakh 40,000. Fine. So here we have not applied any, expected rent and all, because it's all in a foreign country. Okay. Fine. So now
So
we
this
go.
is the net income Rajesh is getting, net taxable income Rajesh is getting in India.
Yeah. So this will be taxable in India because he's a resident in India. He's a resident, but ordinary resident. Okay. So let's
Yes.
look at that. Rajesh, a British national, is a resident and ordinary resident in India during the previous year 23-24. So he owns a house in London and he's getting this much of rent. He's paying some municipal taxes. Okay. So how much tax he is supposed to pay? He has to pay this. Okay. So yeah. Is that okay?
Yes, sir.
So question number two. Okay. This is very important. Read this.
Anirudh has a property.
Okay. Just hold on. Okay. Hold on. Yeah. 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 Read it.
Anirudh has a property whose municipal valuation is rupees 1,30,000 per annum. The fair rent is rupees 1,10,000 per annum, and the standard rent fixed by the Rent Control Act is 1,20,000. The property was let out for a rent of rupees 11,000 per month for the previous year. Unrealized rent was rupees 11,000 and all conditions prescribed by Rule 4 are satisfied. He paid municipal tax at 10% of municipal valuation. Interest on borrowed capital was rupees 40,000 per year. Compute his income from house property for the assessment year 24-25.
So, so to understand that, let's just go back to, this and understand what deductions are allowed. Okay. Okay. Just read this, Kishore.
Deductions from annual value. Section 24. There are two deductions from the annual value. They are 30% of NAV, interest on borrowed capital.
So that means two deductions are allowed. One is the 30% standard deduction. Okay. Fine. Because if you're owning a property and you're earning something out of it, so there can be some case of repair, maintenance, painting, everything. So you're not entirely becomes your income. So you spend some money. So government says, okay, they'll give you 30%, deduction, and rest will be taxable in your hands. And if you have borrowed some money and taken a loan against that property, then any interest which you are paying will be exempted from uh, will be reduced from your property income. Okay. So read this.
30% of NAV is allowed as deduction under Section 24A. There is a flat deduction and is allowed irrespective of the actual expenditure incurred.
So you may be spending whatever, but you are given 30%. You may spend 10%, 15%, but 30% is allowed. You may even spend 50%, but 30% is allowed as deduction from your income.
The assessee will not be entitled to deduction of 30% in case of self-occupied properties, as the annual value itself is nil.
So if you are owning a house and you are staying in that property, it's a self-occupied property, so there is no income, so no deduction will be allowed if it's a self-occupied property.
Interest on borrowed capital is allowed as deduction under 24B. Interest payable on loans borrowed for the purpose of acquisition, construction, repairs, renewal or reconstruction can be claimed as deduction. Interest payable on a fresh loan taken to repay the original loan raised earlier for the aforesaid purposes is also admissible as a deduction.
So if you are, constructing the house, or if you are repairing the house, if you have taken a loan, and if whatever interest you are paying, that will be reduced from your income, and you have to pay tax only after reduction of this interest loan. Okay, and even if you are supposed to prepaid your own loan and taken a new loan against the old loan, so still whatever interest you are paying, that will be allowed. Sometimes people switch, from one bank to another, so we can do that, but whatever interest you are paying, that will be allowed.
Interest for pre-construction period. Pre-construction period is the period prior to the previous year in which property is acquired or construction is completed.
Suppose you were constructing a property and it took you about 3 to 5 years to construct the property, and you have taken a loan. So you have paid loans for those years, 3 years, 5 years, 4 years. So even that is allowed. How it is allowed? Like this.
Interest payable on borrowed capital for the period prior to the previous in which property has been acquired or constructed, pre-construction interest, can be claimed as deduction over a period of 5 years in equal annual installment commencing from the year of acquisition or completion of construction.
So whatever interest you have paid at the time when the property was under construction, so after completion, all that money which you have paid will be allowed as deduction in the next 5 years. Suppose you have paid 50,000 rupees interest, so every year you will get 10,000 rupees as deduction for the next 5 years. Okay.
Interest for the year in which construction is completed, property is acquired. Interest relating to the year of completion of construction, acquisition of property can be fully claimed in that year irrespective of the date of completion or acquisition.
Okay. So with this knowledge, we can just solve this question now. So that means you are allowed a full deduction of interest as well as municipal taxes. Okay. So Anirudh has a property whose municipal valuation is 1,30,000. What is the fair market value? Rent 1,10,000. What is the standard rent? 1,20,000. And this is the property was let out at 11,000 per month throughout the previous year. Of course, you could not get 11,000 because the tenant has not paid 1 month, last month, or maybe whatever month he has not paid you, and you have tried all your best to recover that. And there is a rule 4 which you are satisfied. We'll understand what is that rule. Okay. He has paid municipal taxes 10% and interest on borrowed capital is 40,000 for the year. Compute the income for the house property for 24-25. So let's look at here. So this is computation of income from house property of Mr. Anirudh for 24-25. So step 1, compute expected rent. Expected rent is how much? What is municipal value? Now, the municipal value is given the question, which is 1,30,000. Fair rent is 1,10,000 and standard rent is 1,20,000. Okay, let's look at it. Municipal value is 130, fair rent is 110 and standard rent is 120. So what I have done, I have put all the numbers here. Okay, so municipal and fair rent. Municipal and fair rent. So here municipal value is more, but restricted to standard rent. So that means it is standard rent, 1,20,000. So out of the three, standard rent will compute ER. ER is higher of municipal value or the fair rent, but restricted to standard rent, which is 1,20,000. Now compute the actual rent. What is the actual rent you are receiving? 1,32,000. Actual rent is here. 11 into
1 lakh
12, 1 lakh
32.
32,000. Unrealized rent this, so 1 lakh 21,000. So in this case, compute the now GAV is higher of ER or actual rent. So actual rent is 1 lakh 21,000, which is higher than the standard rent. So that means since you are receiving more money than the standard rent, so that means your gross annual value will be the actual rent. Okay, let me go, complete this. Then municipal taxes is 10%, which is 10% of this municipal value, which is 1 lakh 30,000 is 10%, 13,000. So it is here. Okay, which is here. So this one. Okay. So this is the net value. So that means this is the rental value. This is the municipal taxes. So this is the net value. Now deduction under section 24. 30% of NAV, which is this. Okay. So this deduction is going to get. Then interest on borrowed capital. Interest on borrowed capital without any ceiling. So that means there is no ceiling. You are allowed full deduction since it is let out. If you are having a property which is let out, then you will be allowed 100% deduction of interest. Okay. So without any ceiling, so income from house property will be how much? This. Okay. Now you can just read this. Kishore, can you read?
Treatment of unrealized rent. The actual rent received should not include any amount of rent which is not capable of being realized. However, the conditions prescribed in Rule 4 should be unsatisfied. They are: the tenancy is bona fide, the default tenant has vacated or steps have been taken to compel him to vacate the property, the defaulting tenant is not in occupation of any other property of SSC. The SSC has taken all reasonable steps to institute legal proceedings for the recovery of the unpaid rent or satisfies the assessing officer that legal proceeding would be useless.
So basically, if all these conditions are satisfied, then you will be allowed a deduction of unrealized rent. That means whatever rent you have not got, you can show only 1,21,000 as income. Otherwise, you have to show 1,32,000. Okay. If any other conditions are not met here, then you have to pay tax on 1,32,000. Okay. Whether maybe that the tenant has not paid now, he may pay you later. So, but in this case, you have actually given up all the hopes that you're not going to get the rent. Why? Because the tenancy is bona fide. That means it is bona fide tenancy. Defaulting tenant has vacated or steps have been taken to compel him to vacate the property. He's not paying the rent. So the landlord say vacate the property, and he's taking all steps to vacate the property. The defaulting tenant is not in occupation of any other property of the SSC. That means if he's not living in any other property of the SSC, he may be, it should not be the case like that. If he's living in any other property of the SSC, then he will not be allowed this deduction. The SSC has taken full reasonable steps to institute legal proceedings for recovery of the unpaid rent. Suppose he has gone and taken a legal case, but if he has not done, because he thinks that it will not bring any results, and he has, satisfied the assessing officer, then also he will be entitled for this deduction. Okay. So just to give you an again, so what we have to do is we have to compute all the numbers. Okay. Fine. And so here the actual rent is more than the standard rent. So that's why he is going to pay tax on whatever money he is getting. Okay. So that means there is no suppression. It's all believe that all other figures, he is getting, higher rent. So gross annual value, and then, municipal taxes has to be reduced. Okay. To arrive at the net annual value. Then two deductions are allowed. One is the 30% deduction, which is called the Section 4 deduction, which is for meeting out all his, repair and maintenance and other the property which he has to carry out annually. So he'll be allowed 32,400, and he has taken a loan of 40,000 rupees interest, so it will be allowed. Okay. So income from house property will be 35,600. Is that clear? Any questions? Kajal, Kishore, anyone?
No, sir.
Okay. So now Just read this last question before we close it at this thing.
Purna has one house property at Indira Nagar in Bangalore. She stays with her family in the house. The rent of similar property in the neighborhood is 25,000 per month. The municipal valuation is 2,80,000 per annum. Municipal taxes paid is 8,000. The house construction began in April 2017 with a loan amount of 20 lakh taken from SBI Housing Finance Limited at the rate 9% per annum on 1 April 2017. The construction was completed on 30/11/2019. The accumulated interest up to 31/3/2019 is 3,60,000. On 31st March 24, Purna paid 2,40,000, which included 1,80,000 as interest. There was no principal repayment prior to this date. Compute Purna's income from house property for assessment year 24-25, assuming that she has exercised the option of shifting out of the default tax regime provided under Section 115BA.
Okay. So now this is a self-occupied property. Okay, and she is not deriving any rent from it. So Purna has one house property in Indira Nagar in Bangalore. She stays with her family in the house. Okay, but all other numbers are useless here because she's staying, so there will be no value. Okay, fine. So we can just have a look here. Okay, just read this. Okay, just एक second. So
No,
just यहाँ से करो. In case of self-occupied property.
in case of self-occupied property or unoccupied property, the benefit of nil annual value is available only for up to 2 self-occupied or unoccupied house properties. That is for either one house property or two house property.
Okay, यहाँ से पढ़ो. एक second. यहाँ से पढ़ो. Sorry.
In case of self-occupied property or unoccupied property, where the property is self-occupied for own residence or unoccupied throughout the previous year, its annual value will be nil, provided no other benefit is derived by the owner from such property.
Okay, suppose if you are staying in a self-occupied property, okay, then where the property is self-occupied for own residence or unoccupied throughout the year, the annual value will be nil. Okay, so that means you should not be paying any taxes normally. Okay, read this.
The benefit of nil annual value is available only for up to 2 self-occupied or unoccupied house properties. That is for either one house property or two house properties.
So that means, if you are having two houses, they are either self-occupied or they are not occupied at all. You are occupying one, another house is vacant. So both can be treated as nil value. But in case if you are having three houses, though you will get the benefit for only two houses. So the other house will be considered as deemed to be let out and you have to pay taxes on it. So we'll understand that. Okay. So यहाँ से हम देखते हैं एक सेकेंड. ये हो गया था. Okay. Okay, just read this.
No deduction for municipal taxes is allowed in respect of such property, as annual value means value determined after deduction of municipal taxes.
So if it is a self-house property, you will not get any municipal deduction. Okay, fine. Okay, just hold on. ये पढ़ो.
Deemed let out property. As per the Income Tax Act, SSC can declare two house properties as self-occupied, while she has to compulsory declare all others as rented out. It means the subsequent properties are considered as deemed let out house property. Further, SSC needs to calculate rent based on fair market value and tax is levied on the same. Deemed let out property is also known as vacant property.
So the law says that if you are having 3 houses, okay, and you're not staying, they are all, either self-occupied or they are vacant. For 2 houses, you don't have to pay any tax because there will be no, money you are receiving. But the third house, you have to pay tax on the basis of expected rent. Okay, so that is the law what says. So, it is basically to discourage to people have so many houses. If they have so many houses, they have to pay tax on that based on the notional rent. Okay, so this is deemed let out. Okay, let me just do last one. हाँ ये पढ़िए.
Deduction in respect of self-occupied or unoccupied property where annual value is nil. In this case, the assessee will be allowed a deduction on account of interest, including 1/5 of the accumulated interest of pre-construction period as under.
So here it says that the house is self-occupied. Okay, if the house is self-occupied and the property value is nil, so you are not supposed to pay any tax. But you will be allowed deduction for interest what you have to pay. Okay, if you are paying interest because you have taken a loan to construct the house, so that interest will be allowed to you. So which means that there will be a negative income under this case. Okay, fine. So that negative income can be claimed, can be set off against any income from other head. Okay, so we'll talk about that. So just read this.
Conditions. Loan borrowed before 1st April 99, where the property has been acquired, construction repaired, renewed or reconstructed with borrowed capital before 1/4/99. Amount of reduction. Actual interest payable in aggregate for one or two self-occupied properties subject to maximum of 30,000.
Suppose if you have taken
Loan.
a loan before a 1/4/99, so that year has already gone. So you will be only maximum deduction which will be allowed will be 30,000. But if you have taken a loan after 1/4/99, then what happens? Just read this.
Where the property is acquired or construction with capital borrowed on or after 1/4/99 and such acquisition or construction is completed within 5 years from the end of financial year in which the capital was borrowed, actual interest payable in aggregate for one or two self-occupied properties subject to maximum of 2 lakh.
Okay, so that
Now,
means if you have acquired a property or constructed a property and you have taken a loan, okay, and whatever interest you are paying, you will be allowed actual interest, but subject to a maximum of 2 lakh rupees exemption. So maximum exemption you can claim is 2 lakhs.
2
Okay, in case if you have acquired the property or constructed the property, but if you have renovated the property or renewed the property or repaired the property, and if you have taken a loan after 1st April 99, then the interest maximum you can claim is 30,000 rupees. Okay, but the exemption is limited to 2 lakh rupees in any kind of a case. Okay, fine. So let me just explain this through an example. All of this. Okay, so this was there. So in this case, let's talk about this computation of income from the property of Ms. Purna. Annual value is how much? Nil, because this property was a self-occupied property, isn't it? ये जो property थी, this was the Purna has a property at Indranagar in Bangalore. She stays with her family in the house. Now, all this information is meaningless. The rent of the similar property in neighborhood is this, municipal valuation is there. Okay, so this has no meaning, but only the loan what he has taken will have a meaning because he will be entitled for deduction. Okay, now we calculated what was the interest. Okay, the interest maximum deduction is 2 lakh rupees. Okay, the interest comes to 2,50,000. How? He took a loan. He took a loan of 20 lakh rupees, which is there at 9%, 18. So for 2 years, she paid the loan. So it came 3,60,000. We divide by 5 because it will be allowed in 5 equal installments, which is 72,000. Okay, fine. And Pune paid 2,40,000. Okay, which included 1,80,000 interest. there is no principal repayment prior to this date. Construction was completed on itna. The accumulated interest was itna. So is 3,60,000. This is the accumulated interest which I have calculated here. She paid 2,40,000. Okay, which included 1,80,000 as interest. There was no payment, so that means he paid some 2,40,000 to the bank, and 1,80,000 was the interest. Okay, so which means this was 1,80,000 plus 72,000. Okay, so his total her interest liability was 2,52,000. Okay, so income from house property will have a negative figure. So maximum interest which can be allowed is 2 lakh only. Okay. Fine. So let me just recap here. Now this property was owned by Poorna and she was staying in this house. So which means there will be no value. There will be nil value, annual value of the property. She will not be allowed any municipal deduction. Okay. So that means she doesn't have to pay any taxes from income from house property. But
Yes.
while calculating his income from house property, it will become a loss from house property. So if you look at here, it will be a loss from house property because she paying interest. Now she paid interest to the tune of 3,60,000 for 5 years. So
2
that
lakh.
means every year she will be allowed 72,000, which is here 72,000. Plus she paid 1,80,000, which is written here 1,80,000 interest. Of course, she paid 2,40,000 to the bank, which included 1,80,000 interest for the current year. So she will be allowed full 180 plus 72,000. Okay. So that means the total amount will be 252, but the interest deduction is limited up to 2 lakhs. So there will be a income from, there will be a loss from house property. Suppose, for example, she is having income from capital gains. For example, I'm just giving an example, okay? She is having an income of, say, 5 lakhs as income from capital gains. Okay, fine. So, it's 50 lakhs. Fine. So, this is, the income from capital gains. So, that means the income will be, she has to pay tax on the income of
3 lakh.
3 lakhs. So, she will be allowed a set off if she is earning income from any other head. Okay. So, this income from house property loss, which is loss from house property, will be set off against income from any other head. Okay. Fine. So, but for doing this, what she has to do is she has to opt out of shifting of the default tax regime. But if she goes for the default tax regime, then she can't claim this deduction. Okay, this I'll just read from here. Okay, just read this.
In case of deemed let out property, interest accrued is allowable as deduction without ceiling limit under both the tax regime. However, in case of default tax regime, the resultant loss from house property cannot be set off against income under any other head. Whereas under the normal provision of the Act, the resultant loss from the house property can be set off against income from any other head to the extent of 2 lakhs.
So that means if he opts for the default scheme, then she will not be entitled for this 2 lakh loss. But if he goes for the the normal provisions of the Act, she opts out of the 115 BC. In that case, if he finds that she is getting a benefit, so she has to first opt out of the default tax regime. If she opts out of the tax default regime, then she will be allowed for a deduction of 2 lakh rupees loss from any other head. Is that clear?
Yes, sir. So in case when we rent a house, so we can claim the deduction of accrued interest in both the tax regimes. In case we rent the house.
Absolutely, yeah.
But in case the house is owned by us, then under the new tax regime, which is the default tax regime as of now, we cannot set off the 2 lakh rupees or the interest.
Absolutely.
The loss.
Absolutely. So first of all, let's say in case of a deemed let out property, interest accrued is allowed as a deduction without ceiling limit under both the tax regimes.
Both the
Okay,
tax regimes.
fine. Suppose it is let out. It is let out 100% allowed. If it is self-occupied, the maximum deduction allowed is 2 lakh rupees. Okay, fine. But if you are opting out, if you are going for the default tax regime, then if you are having a loss from the house property, that cannot be set off against any other head. But if you are going for the
No.
normal tax regime, you can claim the set off. Okay.
Yes, sir. Yes.
Well, anyway, so this was just a this thing. So what I have done is, so here we'll finish the lessons. So let me just check here. So these were the deductions. Okay, this is covered here. Okay, deductions from the net value under default tax regime. Okay, suppose deductions allowed from NAV. Let out, deemed to be let out. What is deemed to be let out? If you're having more than 2 houses, one house which you are not staying will be considered deemed to let out, and you have to pay tax on the expected rent. Is that okay? So,
Yes.
you are earning some rent of the house from a house, so you have to pay taxes. Even if you are not earning any tax from the house, it happens to be your third house, okay, which you are claiming to be a self-occupied or a vacant house, you have to pay tax based on the fair expected rent of the house. Okay, so let out, deemed to be let out. And the second one is self-occupied property. So first let's do let out. So here standard deduction is allowed, interest is allowed. 30% of NAV fully allowed, full interest. Okay, fine. Now, in case of self-occupied, no deduction is allowable under Section 24. Okay, so this is under 115A. So no deduction is allowed under the 115. Okay.
Which is default tax.
But when you're going for an optional tax regime and you're going by the normal one, then this remains the same. Here you are allowed, interest on borrowed capital. Okay, where the house is taken on, where it is self-occupied, interest on borrowed, interest where loan is taken for renewal and reconstruction, then maximum amount is 30,000. Where the loan is taken for construction of the new property, and the interest which is paid before construction in 5 equal installment plus the loan in which you are paying. So the maximum deduction is 2 lakh rupees. Okay, fine. So for construction, reconstruction, renovation, it is 30,000. But for other things, for constructing a new property, if you taken a loan, then the maximum reduction is 2 lakh rupees. So this is all.